Okay, so you want to own a skyscraper. Picture it. Your name, or your company's name, glowing near the top of a city skyline at dusk. You take the express elevator, the one that skips the first 40 floors, and your ears pop on the way up. You step out into a corner office wrapped in glass, and the whole city spreads out beneath you like a circuit board, tiny yellow cabs, tiny people, the river catching the last of the light. Down in the lobby there's marble and a security desk and your building's name etched into stone. Every month, dozens of tenants wire you rent. You own a piece of the sky. You own permanence. Long after you're gone, this thing will still be standing, still printing money, a monument with a mailing address. That's the picture. That's what the skyline sells you. That's what the glossy brochure and the ribbon-cutting photo and the movie establishing shot all promise, that a tall building is the ultimate trophy, the safest money in the world, poured concrete that pays you rent forever. Here's the problem. A skyscraper is one of the most expensive, most fragile, most misunderstood assets a person can own. The higher you go, the less of the building you actually get to rent out. The costs don't grow in a straight line, they curve upward, viciously, floor after floor. You can own the building and not own the ground it sits on. You can be fully leased and still bleed cash. And the thing that makes the whole enterprise work is almost never the thing you were staring at when you fell in love with it. Because a skyscraper is not really a real estate investment. It's not really a building at all. It is a giant, vertical, leveraged bet on land and cash flow, a bond wearing a costume made of glass and steel that happens to scratch the sky. By the end of this, you'll understand exactly where the money in a tall building comes from, why the top floors can cost more to build than they'll ever earn, why one of the most famous buildings on Earth sold for a fraction of its value because of a piece of paper almost nobody read, and why the smartest owners in this game aren't really selling office space at all. You'll understand why height is a trap, why the elevator is the secret villain of this entire industry, and why the real profit hides in places you never look, the roof, the ground floor, and the lease. Let's start where every honest conversation about this has to start. Before we talk about money, we need to talk about what a skyscraper actually is. Because skyscraper is a marketing word, not a category. The Council on Tall Buildings and Urban Habitat, the CTBUH, the body that literally settles arguments about which building is tallest, draws its lines at height. Roughly speaking, a tall building starts turning into a super tall at 300 meters, and a megatall at 600 meters. But those are just numbers on a ruler. The real distinctions are about what's inside, because a tall building is secretly 3 or 4 completely different businesses stacked on top of each other, pretending to be one. Some skyscrapers are office towers. You're a landlord to companies, and your fate rises and falls with the demand for corporate desk space. Some are residential. You're selling condos or renting luxury apartments, and you're really in the business of scarcity and views. Some are hotels, which are barely real estate at all. A hotel is an operating company that happens to own a bed. And some are mixed use, the modern default, where you've got retail on the bottom, offices in the middle, apartments or a hotel up top, and an observation deck on the roof, 4 businesses, 4 sets of rules, 1 foundation. Here's why that matters. The office tower makes money from long, boring, 10-year leases. The condo makes money once, at the sale, and then walks away. The hotel makes money one night at a time and can collapse in a recession. Stack them wrong, finance them wrong, and you don't own a diversified asset. You own 4 ways to lose money in the same zip code. For this, we're going to focus on the classic, the big city commercial office tower, because that's the archetype, that's the trophy, and that's where the most brutal and most beautiful economics live. So let's talk about getting in the door. The biggest upfront number, the one that makes people gasp, is construction cost. And in a major market, high-rise office construction routinely runs somewhere between $500 and over $1,000 per square foot, and for a super tall in a place like New York, the all-in cost, land included, can push far beyond that. To put real numbers on it, One World Trade Center in Lower Manhattan came in around $3.9 billion, which made it, at the time, one of the most expensive office buildings ever built. The Burj Khalifa in Dubai, the tallest building on the planet, cost roughly $1.5 billion to construct. A single super tall tower is a number with 9 digits in it, minimum. Often 10. But here's the lesson that separates amateurs from operators, and I want you to hold on to it for the whole rest of this. The price of a building and the profitability of a building are two completely different numbers. They are not cousins. They are barely on speaking terms. You can overpay for a tower that gushes cash, and you can build the most expensive building in the city and watch it lose money every single year. The sticker price tells you what it costs to make. It tells you nothing about whether it will ever pay you back. And the reason it so often doesn't pay you back is the part nobody budgets for. So let's do the section nobody wants to do, the hidden infrastructure costs, the ones that hit after the exciting part is over. First, the core. And this is the one that quietly murders the whole fantasy of just build it taller. Inside every skyscraper is a central spine of elevators, stairwells, mechanical shafts, and structural columns. We call that the core. Now, here's the thing about elevators. The taller the building gets, the more elevators you need, and the more elevators you need, the more floor space they eat on every single floor below. On a very tall building, the core can swallow a huge chunk of each floor plate space you paid to build and can never, ever rent. So you have this cruel math. You go higher to get more rentable space, but going higher forces you to give more of each floor back to the machinery that makes higher possible. Past a certain height, you're building floors that mostly exist to hold up the elevators that serve the floors above them. Read that again. That's the elevator trap, and it's the reason most cities are full of buildings that stop at a boring height instead of touching the clouds. The boring height is where the money is. Second, the facade, the glass skin, the curtain wall. That skin is not decoration, it's a weather system, a thermal barrier, and a legal liability all at once. And it doesn't last forever. In New York City, there's a law, the Facade Inspection Safety Program, what people still call Local Law 11, that legally requires owners of tall buildings to inspect their exterior walls every 5 years and fix anything dangerous. A single inspection cycle can run into the hundreds of thousands of dollars just to look. Actually recladding or repairing a facade, that climbs into the millions, sometimes the tens of millions. The glass box in the sky is a glass box you are legally required to maintain, forever, at gunpoint. Third, the mechanical guts, the elevators again, but also the HVAC, the heating and cooling systems that have to move air up and down a structure the size of a small vertical town. These systems have finite lifespans. Elevator modernization for a whole tower is a multi-million-dollar project. Replacing chillers and air handlers, another one. None of it is optional, and all of it comes due on a schedule you don't control. Fourth, the reserves, the money smart owners quietly set aside every year for the big-ticket replacements they know are coming. This is called capital reserves, and rookie owners skip it because it feels like paying for a problem you don't have yet. Then the problem arrives, all at once, and they can't cover it. So far, so good, right? You've got a beautiful tower and you've budgeted for the skin and the guts and the reserves. You still haven't hit the thing that actually decides whether you win. Here's where it gets interesting. The single most important fact about owning a skyscraper is one most people never even think about. You might not own the ground it's standing on. Let that land for a moment. In the world of trophy towers, there's a structure called a ground lease. It means one party owns the land, and a completely different party owns the building sitting on top of that land, and the building owner pays rent to the landowner for the privilege of existing there. Not rent from tenants, rent for the dirt. And here's the trap, those ground leases can reset. Every few decades, the rent for the land gets recalculated to modern market value, and it can leap by a staggering multiple overnight. You can own a world-famous, fully leased skyscraper and be strangled to death by the rent on the earth beneath it. That is not a hypothetical. That is the story of one of the most beautiful buildings ever made, and it's the case study you need to hear. The Chrysler Building, Manhattan. Completed in 1930, that gleaming Art Deco crown, arguably the most gorgeous skyscraper in the world. Walter Chrysler, the car magnate, paid to build it as a monument to himself and, briefly, it was the tallest building on Earth. A genuine icon. And here's the twist most people never learn. The automaker built his tower on land he didn't own. The ground underneath the Chrysler Building belongs to Cooper Union, the private college, which has held that land for generations and collects ground rent from whoever owns the building. Now watch the arc. In 2008, near the peak of the market, the Abu Dhabi Investment Council, A sovereign wealth fund, serious money, bought a controlling stake in the Chrysler Building in a deal that valued it around $800 million. A crown jewel, bought by a fund that buys crown jewels. The rise. Then the decline. That ground rent, the payment to Cooper Union for the land, was scheduled to escalate dramatically. It climbed into the tens of millions of dollars a year, reportedly jumping to around $32.5 million annually and set to keep climbing toward roughly $40 million. Think about that. Before a single tenant, before a single dollar of profit, the owner owed tens of millions just to keep the building legally standing on its own footprint. The rising land rent ate the building's income alive. An icon, fully occupied, turned into a money loser because of the dirt. And the lesson? In 2019, the Chrysler Building, one of the most famous structures on the planet, sold to the investors RFR Holding and the Cigna Group for a reported $150 million. Down from $800 million a little over a decade earlier. Roughly a 90% collapse in value. Not because the building got uglier. Not because Manhattan emptied out. But because of a contract about land that made the economics impossible. That's not a real estate loss. That's a lesson written in stone and steel. You can own the sky and still not own the ground, and the ground always wins. So how does a tower that does own its economics actually make money? Because the answer is richer and stranger than collect rent. The revenue comes in layers. The first layer is base rent, the boring, beautiful foundation. Companies sign long leases, often 5, 10, 15 years, and pay you per square foot. This is your bond-like income, the predictable heartbeat of the building. In a strong market, prime office space commands serious rent per square foot per year, and because the leases are long, this income is stable and forecastable. This is the baseline of the whole song. The second layer is retail, and this is the secret weapon. The ground floor and the space you can see from the street is worth wildly more, per square foot, than the office space 40 floors up. A flagship store at street level in a prime location can pay rents that dwarf anything upstairs. The bottom of your building, the part you walk past without looking, can be the most valuable real estate you own. The third layer is the roof, and this is the one that'll change how you look at skylines forever. The top of a tall building is prime real estate for telecommunications, cellular antennas, broadcast equipment, microwave links. Carriers pay to bolt their gear to the highest point around, because height is coverage. Your roof, which you thought was just a hat for the building, is a rentable asset. The fourth layer is signage and naming rights, the ability to sell your building's identity, to put a company's logo at the top of the skyline, is worth real money in a way that has nothing to do with square footage. And the fifth layer, the one that turns a building into an attraction, is experience. Which brings me to the single best example of this entire idea, and it's the flip side of the Chrysler cautionary tale. The Empire State Building. Owned by Empire State Realty Trust, a publicly traded company. Now, the Empire State Building rents out office space like any tower, but its observation deck, the observatory where tourists line up to see the whole city, is a business unto itself. Before the pandemic, that observatory generated on the order of $130 million a year in revenue, at margins that any office landlord would kill for, because once you've built the deck, letting one more tourist ride up costs you almost nothing. That's not a building with a nice view. That's a view with a building attached. Same structure, opposite lesson from the Chrysler. One had its income devoured by land rent, the other turned altitude itself into a product. Now, before you get too excited about all those layers of income, we have to talk about the operating costs that never stop. Every single day, that tower costs money to simply exist. Start with utilities. Heating, cooling, and lighting a vertical city is enormously energy hungry, and in a large tower the annual energy bill runs into the millions. Then labor engineers, security, cleaners, building management, elevator technicians on call. A big commercial tower is staffed like a small hospital, around the clock. Then repairs and maintenance, the constant drip of fixing what breaks in a structure with thousands of moving parts. Then property taxes, and in a place like New York City, commercial property taxes are among the most punishing costs in the entire model, a massive, recurring, non-negotiable annual bill that scales with the building's assessed value. Then insurance, which for a high-profile, high-occupancy, high-liability tower is its own significant line item. And then, quietly draining underneath all of it, the interest on the debt, because almost nobody buys a skyscraper with cash. They borrow most of it, and when interest rates rise, that debt payment swells, and a building that penciled out beautifully at low rates can suddenly stop making sense. Add it all up and here's the uncomfortable truth. A fully leased skyscraper can still lose money. Occupancy is not the same as profit. You can have every floor rented and still watch the building bleed if your debt is too heavy, your taxes too high, or your ground rent. Remember the ground rent, too brutal. And that leads straight into risk, because this asset has a particular kind of danger baked into it. The threat isn't a storm or a fire. The real, structural threat is the office market itself, and it moves in long, slow, terrifying cycles. Office demand is tied to the economy, to employment, to how companies choose to work. When a recession hits, companies shrink, they don't renew, they sublease their empty space, and your long, beautiful leases start expiring into a market where nobody wants desks. This is called vacancy risk, and in a tall building it's amplified, because your costs are enormous and fixed while your income can crater. And there's a slower, scarier version. After 2020, the shift to remote and hybrid work put a structural question mark over the entire office tower model. Vacancy rates in major markets climbed to levels not seen in decades, and older buildings that couldn't compete began trading at steep discounts, some effectively worth only the land they sat on. That's the mechanical threat. A skyscraper is a fixed, permanent, enormously expensive bet on a demand that can quietly, permanently, shrink beneath it. The building can't move. The tenants can. There's also the physical tail risk, the rare disaster that reminds you what you're really holding. Consider the Millennium Tower in San Francisco, a 58-story luxury residential high-rise completed in 2009. Beautiful building, premium condos. And then it started sinking, settling into the ground and tilting measurably, more than a foot at the top, as the years went on. The engineering fight to stabilize it turned into a saga costing on the order of $100 million, with lawsuits flying. The lesson isn't buildings sink. The lesson is that a skyscraper is a bet on the ground beneath it in every possible sense, legal, financial, and literal. The cheap foundation is cheap for a reason. So if it's this hard, if the elevators eat your floors, the facade drains your cash, the land rent can strangle you, the market can hollow you out, and the ground can literally swallow you, why do the smartest, richest owners keep playing this game and keep winning? Here's where it gets interesting. Because the sophisticated money isn't playing the game you think they're playing. The first part of the deeper game is leverage and appreciation. Wealthy owners aren't primarily chasing the rental income year to year. They're using a relatively small amount of their own cash, borrowing the rest, and betting on the long-term appreciation of a scarce, irreplaceable asset in a great location. Land in the center of a global city is the one thing they truly cannot make more of. Over decades, through cycles, prime urban land tends to compound in value, and leverage multiplies the gain on the slice of cash they actually put in. The rent isn't the prize. The rent just pays the carrying costs while the land quietly appreciates underneath. The second part is tax. Real estate, especially at this scale, comes wrapped in tax advantages ordinary assets don't get. There's depreciation. The tax code lets owners deduct the wearing out of the building against their income, even in years when the building is actually rising in market value. So on paper, for tax purposes, the building is losing value and generating deductions, while in reality it's appreciating. That gap is where fortunes are quietly protected. And when it's time to sell, sophisticated owners can roll the gains into the next property and defer the tax bill, compounding across a lifetime. The third part is control and identity. Owning a landmark tower isn't only financial. It's a seat at the table in a city, a piece of collateral you can borrow against again and again, a store of value that survives inflation because rents and property values tend to rise with prices over time. The wealthy don't buy skyscrapers to get rich. They buy them to stay rich, to park enormous sums in something durable, tax-advantaged, and self-financing that also happens to put their name on the horizon. That's the reframe. When an amateur looks at a skyscraper, they see rent times floors. When a professional looks at it, they see a leveraged, tax-sheltered, inflation-resistant claim on the most irreplaceable land in the world, with a cash-flowing building on top to pay the bills while they wait. It is not a rental business. It is not a construction project. It is a long-duration bet on land and money, dressed up as a building. So let's make it concrete, the way the operators do, with two numbers side by side. The good year. The economy is humming. Your tower is 95% leased. Your long-term tenants are paying premium rents. Your ground floor retail is packed and paying top dollar. Your rooftop antennas and your signage are cutting checks. Your observation deck, if you have one, is full of tourists at high margin, and interest rates are low so your debt is cheap. The rent rolls in, covers every operating cost with room to spare, services the debt comfortably, and throws off healthy positive cash flow. Meanwhile, the building's market value climbs, and your depreciation deductions shelter much of the income from tax. On paper, you're barely profitable. In reality, you're getting richer 3 different ways at once. That's the good year. That's the brochure, and for once, the brochure is true. The bad year. A recession lands. 2 big tenants don't renew, and a third subleases half its floors, so your real occupancy quietly slips well below what the leases say. The office market softens, so releasing that empty space means slashing rents or offering months of free rent just to get anyone to sign. Retail downstairs struggles and asks for relief. And interest rates have jumped, so your debt payment has swollen at exactly the moment your income shrank. Now your fixed costs, the taxes, the insurance, the utilities, the staff, the facade law that doesn't care about the economy, and yes, the ground rent if you have it, all march on, unchanged, while your revenue falls out from under them. The building is still standing, still beautiful, still lit up at dusk. And it is losing money every single month. That's the bad year. And a tall building can live in the bad year for a long, long time, because you can't shrink it, you can't move it, and you can't easily sell it into a falling market without taking a loss like the one that hit the Chrysler. So look back up at that skyline. That corner office, that name in the clouds, that marble lobby, the tiny cabs far below. It's real. It's beautiful. And it's also the most expensive, least understood illusion in the whole world of investing, because the thing you're staring at is not the thing you'd actually own. The glass and the steel and the height, that isn't really the business. The land underneath it, and the cash flow across it, is.